Good afternoon, everybody. Welcome to day 2 of our fall conference, Connecting at a Distance. My name's Jo Morris with the Fastener Training Institute, and I'm going to be your moderator once again today. Most of you probably joined us on Tuesday and are familiar with GoToWebinar, but before we start, I just want to remind you once again how we're going to interact and ask questions. Today we have a panel discussion. After all the panelists have presented, we're going to open the floor to the audience for questions. So you can type your question in and I can read it, the same that is similar how we did it on Tuesday, or you can raise your hand and I will unmute you. Now, some guidance on how to unmute. Each of you are self-muted. So I can unmute you, but you are going to have to unmute yourself as well. So if you'd like to make a comment or a question, please raise your hand or just type in unmute me. When it's your turn, I'm going to let you know that I'm going to unmute you and I'll ask you, please unmute yourself. So if you've dialed in to the webinar using your telephone, you must enter your audio PIN in order to have the control panel, in order to see the control panel for muting. If you're using your microphone and speakers, you're going to see an orange microphone at the top of your control panel. Orange means you're muted, green means you're not muted. So when it's your turn, I'll ask you to please unmute yourself and just click your microphone and it will go back and forth, orange, green, if you want to mute or unmute. And I hope that's not too confusing. We can certainly just type your question in and I'll read them as well. We really wanted this to be interactive and have everyone speak freely, but there's a ton of people on and there's lots of background noise, so we just have to improvise. All right, let's hope for another strong internet day without connection or interruptions. We are recording this session, so if we encounter some hiccups, you will have access to the replay in a few days. That's all I've got. It is my pleasure to introduce you to Jake Davis, the president of the Southwestern Fasteners Association, as well as the president of BTM Manufacturing in ISCO.
Thank you, Jo. Much appreciated. Hello, everyone. Good morning to our West Coast friends and good afternoon to everyone. Really appreciate everyone joining us for our virtual conference, Connecting at a Distance, put on by Pac-West, SEFA, and the Southwestern Fastener Association. As Jo said, we hope all of you had the opportunity to tune in on Tuesday to listen to the economic update with Dr. Chris Thornburg. It will be, video will be made available later at a later date, but I myself enjoyed the optimism for once. So looking forward to a good panel discussion today. The conference is brought to you by sponsors, and I just want to name a few of them. Our premium and premier sponsors: Indie Industries and Star Stainless, Brighton-Best International, Birmingham Fastener, BTM Manufacturing, and Eurolink Fastener Supply Service. And lastly, our thanks go out to Jo Morris with the Fastener Training Institute for your continuous technical support. Now on to the presentation. Let me introduce presentation, What's New, What's Next, State of Our Industry. Our 4 panelists are Mike Bailey with Nucor Fastener, Jamie Lawrence, AVK Industrial Products, Tim Roberto Jr. with Star Stainless, and Jun Xu with Brighton-Best International. So please join me in welcoming our panelists.
Thank you, Jamie. Are you going to kick us off?
Yes, thank you. It's a pleasure to be here and speaking to all of you. It's a pleasure to be speaking with this great array of panelists, and I hope you find what we have to say constructive. So what is happening? What's going on now? Since COVID, it's been rather a big bump in the road for the fastener industry, but not only the fastener industry, for the world and for our gross domestic product. But it's not all doom and gloom. So why don't you switch to the next slide, Jo, please? Thank you. So looking at the GDP, if you look down at the bottom chart first, there's kind of a summation of 2016, 17, 18, and 19 of the gross domestic product, and you see it was bumping along pretty well. And 2019 was a high point. 2018 was a high point. 2019 was smoothing out a little bit, and then boom, COVID hit, and you can see that drop at the end of the top chart. You can see that bar dropping way down, where the gross domestic product really took about a 5 to 10% drop overall. and we're really in the Dead Sea, so to speak, for about 2.5 months. I know April, May, June was very, very quiet, and business, I think, worldwide, in addition to the fastener industry, and I'm making a generalization, really dropped about 50%. But there's hope on the horizon. So Joe, let's have the next slide, please. Okay, according to many U.S. economists, and I know the doctor of economy was speaking earlier or yesterday, and I think had some positive information, and I'd just like to support that. U.S. economy may recover in pre-pandemic levels by Q2 2021, according to leading macroeconomic influencers. And of course, macro economics is the overall economy, GDP, import, export, whereas microeconomics is more industry focused and total consumption and profit and what have you. But anyways, it looks like, and we're already starting to see signs of the fastener world recovering and general industry recovering, specifically, of course, the distribution, fastener distribution world, automotive, heavy truck, bus. Okay, let's have the next slide. Okay, but before I give you some economic indicators, let's just talk about the global fastener market as I see it and what information I have. And it depends on the source you have. So again, this is general direction, but 2018, 2019 through 2025 global fastener market last year said was going to be forecasted to grow at 5%. Now they're saying 4.1%. So really slowed up a little bit, but nothing of a big drop. It's still in a good growth trajectory, and that we can see already picking up in the fourth quarter here. The fastener market was only momentarily frozen and seems to be recovering. However, with growth rate has slowed to 110 billion. 110 billion is a lot. That's not much of a slow. Last year was projected to be 134 billion. So we've dropped back a little bit overall to 110 billion. So still a very, very strong global market for the fastener industry. So there's positive news there. Joe, next slide. Okay, and then this probably won't come as a surprise to any of you, since all of you are in the distribution world, but just data mining and looking for information. How did COVID-19 affect us? Well, here are some larger companies that you may be familiar with: Grainger, MSC, Wasco, and Systematic. And you can see, of course, it won't be a surprise to you, that their digital business really picked up. You can see 67%, 61%, 33%. The last company, 100%. But a lot of these companies are large and they do a lot of business via the internet, but more and more of the distributors during the pandemic and maybe moving forward will place more emphasis on digital or B2B business. But a couple other suggestions would be directly affecting the 4 ways to help directly affecting production and demand, creating supply chain and market disruption, and by its financial impact. These items really impacted the business world from the COVID effect. Let's have the next slide. Okay, what are some things you can do to protect yourself and help increase your business efficiencies? And many of these I'm sure will be common sense, so you already know. Old school, have some safety stock. I know over the last 2 years or so, the distribution base, from what we see, has really thinned out. It's been more just-in-time inventory. But if you have inventory for your key customers, that would protect you against any kind of supply chain disruption. Shift labor. If you're doing a sub-assembly or some kind of product outside of the world, Taiwan or China or wherever, maybe bring it in closer, maybe try Mexico. New processes. If you're using older equipment in your manufacturing process or your assembly processes, Maybe you want to invest in newer equipment to speed up your assembly. Continuous flow manufacturing. I think you've heard this in the past, used to be called flexible manufacturing, but basically it's saying make your product from start to finish in the same assembly line, so you have maximum efficiencies of manufacturing. And last but not least, of course, automation. Can you automate what you're doing, packaging or assembly or production, to gain efficiencies and profitability in this particular time? So something for you to consider. Next slide, Joe. Okay, as an economic indicator, I always, if you've seen some of these discussions before, I always like to use Class 8 truck, because Class 8 truck is an excellent economic indicator. Heavy truck, 18-wheelers, Class 8, really are a good snapshot of import-export business, as well as trade and freight moving around the US and North America. They're the first to drop off and the last to come back. And as you can see, what happened during the pandemic, look how truck just plummeted, and they really dropped off by, again, 50% as well. But, you know, a positive note, in August, Class 8 trucks started to recover. Import-export business started to pick up, and you can see that trend reflected in the recovery or starting recovery of Class 8 truck, but I don't see a full recovery of Class 8 truck until at least Q2 next year. But again, a positive trend, it is picking up. Next slide, Joe. And last but not least, let's talk about automotive. And automotive is usually a market that doesn't rebound well, but in 2019 and moving into 2020, there's a high demand for new vehicles. There's a high consumer demand that's been pent up. So we were moving along very nicely. Last year was 17 million units for automotive. During the pandemic, COVID-19 shutdown, where much of the automotive industry completely shut down, including Chrysler and Ford, they went to zero. And so instead of doing 17 million units this year, they came back and they said, for the last 6 months of this year, we're going to forecast 14 million units. Well, again, as of August and part of September, they have already increased their output to 15 million units annualized, and now they're thinking they're going to be doing 15.5, maybe more, in just 6 months. So if any of you are dealing with the automotive world, you're going to see a definite increase in demand rapidly, with a requirement for rapid support. So you can see the green line there had it starting to recover, which is also a very good economic trend, signaling that consumers have extra income or disposable income, and they're ready to buy it and place it on new products. So heavy truck is recovering slowly. Q2, automotive is definitely recovering very quickly for this quarter, Q4 and Q1, and we see the distribution market picking up also worldwide. So I hope you found some of that information interesting, and I appreciate your time. Thank you. And that's it, Joe.
Thanks, Jamie. I'm a little stunned that you didn't have your chart with how short the skirts are as the economic indicator.
Yes,
but I recall
usually
from all of your other presentations.
That is right. What Joe's referring to, if you don't know, historically proven since the Depression, that the hemline of ladies' dresses also signal how the economy is doing, if it's doing poorly or not. If the skirts are short, the economy is doing well. If the skirts are long, then there's a problem and you're going into recession. I'll do that next time. I'll remember to put the hemline forecast in there for you.
See, aren't you impressed? We've listened all these years.
I'm impressed. You listened to me. Okay, thank you.
Thanks, Jamie. That's optimistic and good to hear. All right, Mr. Mike Bailey. Mike may not be joining us with his webcam to save some internet speed. Thanks, Jamie.
You know, first of all, following Jamie with really pristine, pretty graphs and everything is really sucks. I don't want to do that again. Great presentation. I'll be coming back to a lot of the things he said, maybe a little bit more micro to his macro, but awesome job. Go to the next slide, please. I'm going to be going more on what I've spoken with customers about and what Nucor Corporation is kind of projecting across all of their divisions. We've been pretty bullish. Nucor Fasteners, no exception. Most of you subscribe to or sit in on the ITR sessions when you get them. All of their economic indicators right now are green for 2021, as well as talking with our customers. Again, echoing what Jamie said, there's a positivity out there. And what I found weird, I try not to be a political guy, but you always have horror stories depending on which side, who wins. It seems like there may be a small bump, but regardless of who wins, it seems the governmental spending is going to have to be out there. It's going to have to be big because they need people working again, and that should translate pretty well into the private sector. Next, please. Back one. I'm just going to touch real brief on this, and we got a lot of questions we're going to have. Heavy truck automotive, I'll run through that quick. Non-residential construction, infrastructure, MRO, and then the doom and gloom one on the bottom, oil and gas. Following up with what Jamie said, he had a graph that was next, Joe, I'm sorry. He's going to support what I'm saying. Trucking was dead in April. A big part of our business goes into the heavy truck market, but as his chart showed, we started seeing an uptick. What we have found on the different truck manufacturers we've talked to, the biggest speed bump, not so much the COVID, but it seems to be supply chain issues with employees not being able to get their products in. Fasteners notwithstanding, there's a whole lot of stuff that goes into trucks, and that seems to be slowing down the processes as much as anything. Seems to be echoed in most of the market segments as well. Hopefully that lessens up as incentives to not work kind of go away, and we get to see these supply chains picking up a little bit. Next, please. Okay, non-residential construction, oddly enough, has been pretty strong for our distributors and from Nucor this year. We've had a couple of large, high-profile jobs that have kind of come to conclusion. May have seen the article on the Rams Stadium in LA, the ballpark in Arlington, and we were just discussing a little bit the World Series will be played there. A lot of big projects that saw some decent growth in 2020 and the end of 2019. Not really a lot of those on the horizon as of right now, but from an industrial standpoint, looks like there is a lot of business that was out there prior to the pandemic. I don't know if the Industrial Info Resources out of Sugar Land shows that there was $83 billion between Pascagoula and Brownsville that needed to be done, and none of those projects were completed as of yet. Many are in beginning stages. Some have been plodding along, but they still need to be built. Already been greenlit and funded. Next slide, please. Infrastructure has been talked about a great deal. Right after Trump got elected, he put a package out there that the House didn't like. July, the House put one out that Trump didn't like, but the numbers are extraordinarily strong. 1.5 trillion from the House. The current budget for 2021 is showing 1.3 trillion. So something's got to give on that. As Mr. Thornburg talked about, there's a chance that from a federal standpoint could be pushed down as other needs arise, but the state level spending is expected to be above average for roads, bridges, and power transmission lines as well. So I would expect that to get revisited by whoever wins in November. Good way to get people back to work pretty quick. MRO slide, Jamie, next one. MRO business, many of the companies that Jamie mentioned, they all had a really strong pandemic sales, and I don't see it. I'm a fastener guy, but I've spoken with several of them, and their PPE business has gone through the roof to the point where the majority of them I've spoken with said that will change how their business is done moving forward, because when COVID is gone, and I'll put quotations around that, I think the PPE necessities and requirements are going to be driving a lot of that business. They all feel really, really strong about the fastener side coming back next year as well. MRO business, it's a good business to be in. It's going to be strong. And I think their growth in 21 and 22 is going to be sustainable. This is the one I really didn't want to put in. Next slide, Jamie, sorry. I live in East Texas. We live and breathe by the oil field out here, and this is a tough one. I've got a lot of friends, some family that have been laid off because of the downturn. In April of 2020, I don't know how you guys follow this, It saw a 5-year low of $19.33 a barrel. For a brief period around that time, we actually saw a negative price per barrel that people were having to pay people to take oil off of their hands. I'm not as old as some, and I'm older than most. I've never heard of that before, but it was not good for the economy here. So what's it going to do? As of a week ago, it was up to $42.45 a barrel. Nice increase, but from everyone I've talked to and everything I read, the sweet spot per barrel is $65 to $70. That gets people employed. That gets the wells pumping, and very few of the indicators I've seen is seeing that coming back to that until late 2021 at the earliest. Last thing I got to say is election years always make for interesting planning, budgeting, forecasting. I tend to lose a little bit extra hair this time of year, but given all the indicators, the market trends, and something that Dr. Thornburg mentioned specifically, a strong U.S. resiliency, I see a strong rebound coming, puts us back on the path for sustained economic growth. I don't think it's going to come roaring back, as Jamie mentioned as well, but I think we would take a little bit better than a whimper, and I think it's going to be much stronger than that. So sorry if I talk fast. I know we got a lot of questions to get to. That's all I have. I appreciate you guys. Thanks.
Thank you, Mike. That was very insightful. Mr. Roberto, you are next.
All right. Yeah, Mike, thanks for sharing about the World Series. Just a reminder, root for our Dodgers who are in the World Series. I'll put Kershaw aside. What we're going to focus in on this session is going to be on material. It's going to look at especially stainless, because that's what I focus in on. So we're going to look at nickel and copper. If you can go to the next slide. Thank you. Coming into 2020, yeah, we were pretty cavalier. We were getting ready for a better year than 2019. 2020 hit. As you can see, we had to adjust. Jim Law, if you were on this session, I apologize. You were right about COVID. Didn't get to the point where we started eating our pets, like you said, but it hit pretty hard and we had to adjust. You saw your competition get hit in the face. How do we adjust? You get a visor. And so I think 2020 was about adaptation, including even Star. We were able to send people home. It was hard for them to pack up their Cardex and go home. Most of you probably don't even know what a Cardex is, but we sent people home. It was adapting to 2020. I think that's a continuation after COVID hit. We felt the gist of it in March, April, and May. And afterwards, it's going to be adapting to that. Next slide, please. I love this quote from Paul Bryant. He says, it's not the will to win that matters. Everyone has that will. Really, it's the will to prepare to win that matters. For us, this is exactly why we have the associations, why we have a Vegas show. This is why we have FTI. It's because we need to prepare for these things. One of the benefits that you have from this panel are for people who see more on the macro level, who want to help you on the micro level to be able to make those decisions you need to do. But it's about being educated. It's about coming to matters with that. It's the communication that we need so that we're all on the same page. I think that's exactly what it is to give you the information you need to make the decisions that you need to make. And I think it really is about preparing. And so I want to take you through the metals in stainless to get you to understand why you're starting to see these numbers start to rise. So next slide. Nickel and copper are relevant again. Nickel teased us last year. It seems like we do this meeting every time in the fall, and it seems like every time we do it in the fall, nickel and copper are rising. And I bet you probably think that somehow that's related to our session. It's not, I tell you. We don't. I wish we had that power, but I know that's illegal. So instead, what we do is we just tell you what's happening and what we see. So what we've seen over this past year is an influx of nickel that went up, came back down, went back up. Copper, again, had been dormant for a long period of time. Now that's starting to rise again. And we're going to take a deeper look at both of these metals because they're going to be important for the stainless, the brass, and the silicon bronze. Next slide. All right, so we're going to look at nickel. Nickel, again, a lot of people give us a hard time. They say, oh, why do you guys always talk about nickel? It only makes up about 8 to 14% of the fastener, but it really does make up about 30 to 40% of the pricing. That really is your leading indicator for where pricing is going. So we look at nickel. And over the past 5 years, we've seen a depressed stainless market in terms of pricing, largely exactly because of nickel. Remember, the last couple of times we've talked, it's always about supply and demand, supply and demand. And so what we've seen in the last years has been the supply of nickel has outpaced the demand. Last year we were talking about how it seems like the LME markets were starting to go down in their supply, but then we talked about ghost warehouses and how there was an influx of a flood of nickel that all of a sudden started to pop up again, but there is nickel out there. And what we've seen so far this year is the same thing. We've seen an oversupply until about August, and then we started to see supply start to go back down, and then we saw that there was at least on par for what is being demanded, what is being supplied. We'll look at the 5-year average, and that time that I told you was a little depressed. That's 5.48 a pound. Just for some context, the previous 5 years before that, the average was 8.56 a pound. And so we look at our 20-year average is 6.98 a pound. We could see that those last 5 years were definitely down. If we can go to the next slide. This chart shows you kind of like I was just telling you that 20-year view. And I know you always tell me, Tim, get over 2007 and 2008, but man, wasn't that a good time for stainless? I know, I miss those days. But if we look further back and we look at the 5 years, what you'll see is this line, the dotted line is your 20-year average. And what you see is only once, well, technically now twice, did it actually achieve above that 20-year average. What that's saying is it's been a depressed market for the last 5 years. We've seen that. There has been an influx of supply, and the demand just hasn't been as strong. And we'll talk about where that demand came from and why that is. Next slide, please. So let's specifically look at nickel over this past year. This time last year, we were looking at nickel at 8.39 a pound. And that started to rise up because of the speculation. I don't know if you remember what we talked about last year, if you were in on that conversation, but what happened was Indonesia said that they were going to ban nickel exports, and people freaked out. And some people said, hey, this is a chance to make money. And so all of a sudden nickel spiked up, and we saw it spike up, and then we saw it come back down pretty quickly. From that peak of September 2nd, 2019 last year to March 29th, we saw nickel slip. So we saw the peak, then we saw it come back down, and it just continued to come back down. Last year, we didn't see the large increases during the uptick. It seems like you who are smart buyers, I think you were a little concerned. There was a lot of uncertainty last year. And so what we said is, let's wait this out. We saw people who draw off their inventory to say, hey, let's wait this out rather than replacing it with higher price inventory. And so a lot of people waited that out, and it came back down because I don't think there was that demand to back it up, to hold up that price increase. And that's why we saw that it was very short-lived. It was a quick up, and then it was a quick back down. And that would continue to come back down because of COVID. That's also because we saw an overall drop in demand. Next slide. So from March 24th, 2020 to September 1st, 2020, we saw a steady increase. So like I told you, March hit at that bottom mark of the 507, and then it got all the way up to 7.14 a pound. As of today, it's 7.15 a pound. That's an overall increase of 41%. If you're looking at the finished goods and say, okay, Tim, what does that mean? That would roughly be anywhere from a 12 to 15% increase on the overall price of finished goods. There's other things that are playing a factor in that price, and we'll talk about that in a little bit. But just from the basis of nickel alone, that gives you an idea that how far we've come. Since September 1st, we saw it come back a little bit. You see where I did this slide on October 13th. This is why we don't do these slides very often, because it's always changing. October 13th, it was 690. Well, as of today, it's back up to 715. And so there is this sense of that ongoing volatility of stainless, at least for the time being. And so you ask, why the increase? That's a great question, Tim. Number one is because nickel. Again, like I told you, nickel is that main driver. Let's look at why nickel has changed. Elon Musk sneezed. No, not quite. But he did call for people to want to mine more nickel. And I think there is this ongoing feeling that nickel is going to take off because of electric vehicles. Even if that be the case, that's going to be your high-end nickel that will take that out of the market, as opposed to the lower-end nickel and even the pig nickel that can be introduced because price gets too high. But a lot of these articles were coming out that oh, nickel's the new gold. And so people were starting to get interested in it. But the real main reason for this year, we seeing an increase is demand. Remember, supply and demand increase. And I know we look at it and we say, well, I don't know if I'm feeling it necessarily in the US. Chris, I think, did a good job of saying where we see the US rebounding, we're seeing Europe rebound. But ultimately, it's going to sound weird, but when it comes to these metals, specifically nickel and copper, it's not about the US and Europe. It really is about China. And so what we've seen in China is improved manufacturing, industrial sector numbers. And the reason we say this is because China consumes 53% of the world's nickel. So even if the rest of the world's pretty flat and even like down a little bit in their demand, 53% of the world's usage is up in demand. And so that will cause prices to change. Some of the factors that we've seen, production of metal increased just alone, 3.3% this year alone. That means they're producing more metal, and yet now we're getting to a point where actually demand is on par with supply, where it was over an oversupply for a long period of time. Industrial output in China rose 5.6% in 2020. This is over 2019 numbers. So even in the midst of a COVID or in the midst of a pandemic, you're still seeing increasing numbers. Manufacturing rose 6% in China, 2020 over 2019. So we're seeing all these positive numbers out of China's growth. I was reading an article this morning that they think even in 2021, China will grow again and outpace the rest of the world. And so what we see on the metal side, at least, is that we know that that's a steady demand. Now on the stainless finished product side, what do we see? Confidence. I don't know if you see Eric from Fasteners Clearinghouse puts out the FDI and the FLI. I think that's a good indication, going back to being prepared and planning, is seeing what other people see. Your forward-looking index this past September was 60.6. It's the highest it's been in 2 years. The consumer confidence index in the US was the highest increase in September that we've seen in 17 years. That means even in the midst of pandemic and the unemployment, like Chris said, a lot of other people are seeing positive signs and they're getting more confident in it. Just for argument's sake, I wanted to show you some numbers. September 2020 was 101.8. August 2020 was 86.3. But I want you to look at the lows and the highs. The low was February 2009, which consumer confidence was 25.3, where in May, which was an all-time high, May 2000, was 144.7. You can see that we're a lot closer to the high than we are to the low. So that shows you that we're in a good trajectory towards confidence. Next slide. So just again, an overall look for nickel. You can see where we've gone in this past year. You kind of had the dip. In the middle was, again, the March COVID-related, things slow down. And then steadily since has been increasing. Do we think it's going to stay at that level and increase that high? Probably not, just because I think you have the rest of the world that's continuing to slowly get on board. But at the same time, I think when it's all said and done, you will see a higher number than what we started with. I think you will see increases in nickel going into 2021, probably not at where we see it right now. Some of the other things that I think you're seeing that are causing some of the finished good prices to be in flux. For us, we're seeing a lot of the exchange rate with the NT dollar. That's changed over 10% in the last 3-4 months. Then you're also seeing freight, which I think John's going to talk about in a little bit. But these are all different indicators of why other increases are coming at this time. And so I think we'll see it relent a little bit, but not back to the point where we saw it before. And so I think it's getting prepared to realize, well, stainless may be in a little bit of a higher price index. So how do we deal with that? Next slide. Did I freeze? Next slide. There we go.
We're at copper. Sorry.
Yeah, no problem. We're going into copper now. Copper, again, just a background, it's the largest price driver for brass. About 60 to 65% of brass is made up of copper, and silicon bronze about 94 to 98%. So copper is even more indicative of the price of brass and silicon bronze than nickel is to stainless. It's a good way of looking at that to understand where the pricing is going. This time last year, copper was trading at 262. As of October 13th, it was 305. As of today, it's 312. And so we see the swings from earlier this year to today. That's a 48% increase. And so for us, again, that's dealing with that sense of increase, how do we prepare for that? In 2020, we saw big swings in copper. From January 16th to March 23rd, we saw 27% in the drop of copper itself. It went all the way down to 210 a pound. And then from March 23rd to September 21st, we saw an increase to 309, about 48%. And so again, if you're dealing with brass and silicon bronze, that's an indicator of a large increase in the price of where you're going to be looking at. While COVID had a temporary impact on copper, ultimately the economic rebound of China plays a heavy part on copper as well as nickel. You're going to see nickel and copper were almost parallel in the way that they went down, but also the way that they went up. Like I told you with nickel, China consumes 53% of the world's nickel. For copper, China consumes 51% of the world's copper. One of the other things that is causing a little tension right now in copper is the fear of a strike in Chile. Chile, probably you wouldn't know it, is one of the world's largest producers of copper. They already have one mine who went on strike, Candelaria, but they only do about 10,000 metric tons a month in production. Another mining company, Escondida, is prepared for a strike. That's 100,000 metric tons. That's 10 times the amount. And so there is some trepidation that those kinds of strikes will cause even less of a supply with demand that's growing in China. That will cause an even greater influx of price. And so we have to keep an eye out to see how that affects it. Also keep an eye out to see where the news goes with Escondida going on strike. Next slide. So again, like I told you, if you compare those charts, copper to nickel, you'll see that they were very similar, very parallel in the way they came down and the way they went back up. A lot of it, again, is that metal-driven, that supply-driven price index that you're seeing that's driving a lot of these prices. Just like with nickel, copper's gone up, and it's gone up pretty fast. Do we think it can sustain itself in that? That's hard to tell. When you look at the rest of the world, it's still lagging a little behind. I think if you have a strike in Chile with Escondida, that could hold the price for a while. But I think we have to look at some of the other indicators that are going to happen. How does the US and Europe continue to recover? Like Chris said, we're going to have to look at how we recover from COVID. I think those are going to be interesting indicators to see how it goes. In summary, I remember sitting in a ballroom 12 years ago, and I don't remember where we were, but I remember Barry Porteous having to give a talk on why steel prices were going up. And I remember him basically trying to tell you that steel prices going up was a good thing. And they almost booed him out of the building. And it was like, Barry took some time to talk about it. I'll never tell you that this is good, because I know we have to deal with pricing contracts. I know we have to deal with a lot of the issues and pressures that customers put on us. I think, like Jamie said, we have to look ahead to see how can we resist some of these things. Part of it might be for us is like thinning out some of that inventory. Part of it might be for us looking at longer term contracts to simply say, okay, how can we get around some of these price increases? Maybe if we buy bigger or bring in some more inventory, that can help offset some of it at a cost discount to offset some of the price increase. I think it's going to be in relationship with your vendors. I think what's going to be important, specifically in stainless and brass and bronze, is to have those conversations with your vendors to simply say, okay, what are some of the avenues that we can do to hedge some of the things that we're looking at for the price increases, and working with them. I think everything that you're going to see and everything we talk about always comes back to that relationship. And I think it really is delving deeper into that relationship to say, okay, how can we partner up to see what you're seeing? Part of it is helping your customers to see what we're seeing, and educating them. This is what's going on. Doesn't mean I'm raising your prices right now, but I'm at least letting you know what we have to face. All right. Thank you for your time.
Thank you, Tim. As always, that was great. John, it is your platform.
Great. Hi, everyone. You know, I would say it's great to see everyone, but you can't see anyone. So, you know, before I start, I think, you know, as companies, you learn a lot about yourselves in challenging environments. Nothing's been more challenging than 2020. But I think as an industry, we've learned that we are incredibly resilient. ever since April, we've come back month after month after month with improvements. And we also learned that we're obviously an essential business and all that stuff, but we're certainly one of the luckier industries out there relative to some of the other sectors of the economy. So I just want to start with that, and then let's go to the next slide. So I know in these presentations we tend to talk about material prices, currencies, and freight. So I thought I would just kind of put all that on the first slide. On the left-hand side is material prices. So you have Taiwan and China there. What's happened in Taiwan? So what I also did was I benchmarked everything off of Q4 2019. So the average prices of the fourth quarter 2019 was basically baseline at 0%, and everything else is basically a fluctuation in percentage terms from that baseline. And I've always found relative change to be more important factors than absolute dollar numbers in these situations. But in quarter one of 2020, the material prices in Taiwan went up about 5 to 6%. We saw a dip in quarter two, so starting April, as COVID was hitting the US and Europe. But today, as of right now, we're roughly about 4% above where the first quarter was before all of the COVID situation started happening. On the bottom chart is what's going on in China. And in China, the real difference is that it's more of a spot market versus in Taiwan, it's more of a moving average. So what you'll see in China is more exaggerated changes since it's reflective of what's going on at that point in time. But similarly, if you benchmarked everything off of Q4, in Q1, there's about a 4% increase. Things started really slowing down in China in Q1 since they were affected first by COVID. But you can see starting in May, they started recovering pretty aggressively. I mean, that's almost a perfect V shape. And where we are right now basically is about 2 to 3% above where Q1 was, I would say, at the start of January. Another factor to this is currency. So that's the top right chart right there. And relatively speaking, I think a lot of currencies move in the same way relative to the dollar. I know that's a generic statement, but what I did was I picked the Taiwan dollar since that's what affects us quite a bit. So historically speaking, I would say the US dollar to Taiwan dollar conversion is about 30 Taiwan dollars to $1 US. We've seen the US dollar start to depreciate basically the mid part of Q2, and especially accelerated depreciation most recently to about 5% from where we were from the start of Q2 basically. And that's actually across the board. I saw the same pattern for some of the currencies, and I think a lot of things drive currencies, but part of it obviously is how much money you're pumping into the economy, and the more money there is, the less valuable it is. So when the US dollar depreciates, things get more expensive to purchase, and when the US dollar appreciates, things get cheaper to purchase. But the real story too is freight. Freight is that bottom right-hand chart. And what this is basically freight rates, spot rates from China to the western coast of the United States. And you can see, from the last 2 years there, historically, it's around the $1,500 to $2,000 per container mark. Most recently, it's gone up to about $4,000 per container. And I think there's several drivers for that. So one driver is that during COVID, demand dropped, and a lot of shipping companies actually pulled vessels from service. So you had a lot of further consolidations. Things were delayed maybe 7 to 10 days. That was kind of going on in Q2 and Q3. Most recently, I think what we've seen is that because, as I think all the previous speakers have shown, things are recovering, and people are finding that they don't have enough inventory. So I think we're seeing a surge of imports. And also, Q3 historically is Christmas shipping season. And I think a lot of retailers are expecting a fairly strong Christmas season. I mean, think about it, it actually makes sense, right? I mean, it's nothing better to buy than buying a big screen TV to make yourself feel better. But you know, people aren't traveling, they aren't eating out. There's more disposable income that people have, and so you know, retail-wise, I think that's going to be pretty strong for our economy in Q4. Next slide. So what we did was we also asked our factories about kind of what they're seeing. Our factories, I find factories tend to have a pretty good global perspective because they're shipping to everyone. They're shipping to the U.S., they're shipping to Europe, or, you know, the factories are all kind of centralized, you know, in Asia. So, you know, what they've told us basically is that U.S. businesses have started recovering, especially since sort of August and September, and mainly for small screws and construction bolts, so construction supplies, construction fasteners. China has been bolstering its economy really by investing in infrastructure, which is you know, they typically do that. They invest and roll out fiscal packages to, you know, they build high-speed rails, they, you know, build buildings, and but two big parts of the investments are solar power, wind power. So China's been, you know, playing the fiscal stimulus card, and at the time of writing this, we were expecting the 3 to 5% GDP growth. And I think maybe last week or a few days ago, they said growth was about 4.9% in China. Europe continues to struggle. I would say it's getting better. You know, we're in the UK, but you know, we're hit by sort of this third wave of COVID. I think Europe, a lot of countries are going through intermittent lockdowns still. So it's sort of a start and stop process. And, you know, hopefully in the US, we never go through another lockdown, but they're certainly playing with that in Europe. From our perspective and what we've seen as a company, generally speaking, I would say construction has been very strong. Interest rates are low, so, you know, residential housing, industrial projects, I think have been fairly robust. Manufacturing is recovering, and this may be more of a dated opinion, but you know, what we saw was that smaller manufacturers were able to recover faster, basically. Larger manufacturers with more people, it's just a simple, you know, logistical issue. If you have 500 people in a factory versus, you know, 50 people in a factory, the number of steps you have to go through to reopen that factory is significantly different. And I think Mike's touched on this. Oil and gas has been terrible, you know, but we're seeing improvements in October. So where we're seeing that improvement actually is we sell a brand of gloves called Kong. It stands for King of Oil and Gas, and it's actually quite well known in that sector. But what we've seen is that sales have picked up in October. And generally speaking, I think when people are buying safety equipment for you know, their people, then they're hopefully hiring the people to, you know, fit those gloves in. And so we are seeing some improvements there. You know, we're obviously in PPE as well. You know, PPE, we believe sales will continue to stay strong even after a vaccine's been developed. Frankly, I think the psyche of the workforce has changed in terms of what PPE is required for the workplace. So, you know, it's not like, you know, next flu season, people aren't going to be concerned about PPE anymore. And the other, you know, sort of unfortunate fact of modern day is that viral outbreaks have become more frequent. So I just went to the CDC real quick and put up a timeline. It'll probably scare you if you look at it in too much detail, but you know, before COVID, there was Zika in Brazil. Before that, there was Ebola. Before that, there was MERS, H1N1, SARS out of Hong Kong and China again. So, you know, the frequency of these type of viral outbreaks are not slowing down. In fact, they're actually ramping up. And I think it's a big part of it is the, you know, air travel. It's also, you know, we're going into the rainforest and cutting trees down for farming, and probably getting into contact with species and type of animals that have never been in contact before. So, you know, the viral outbreaks, you know, it's not going to stop at COVID. It's an unfortunate sort of fact of you know, modern living, I think. Next slide. So, part of the topics was, what's next, what's new. And I thought I would kind of put out three main topics out there. We're by no means the experts in any of this, but I do sort of get a sense that these questions reoccur in conversation. So the first one is, will our industry get Amazoned? My opinion is that it's not. And the real issue is not with the company Amazon. The real issue is with the customers that they're selling to, the end users. Search is really not optimized for end users to search for fasteners. So there's just too many parameters that you have to figure out, from grade to material to size and plating and all that stuff. So it's just not optimized for people to look for fasteners. It's not a book title. And frankly, before end users are even trained to start thinking about how to search for fasteners, I think 99% of the economy would have to be Amazon before that. So, frankly, we'd all be working for Amazon by then anyway, so it wouldn't really matter. The second issue is, I think, the value per shipment. So Amazon started with books. It was actually quite smart for the way that they did that. But fasteners are not books. Books go for, I'm guessing, $16 per unit. Fasteners, they're bought and sold per piece in pennies, right? So we buy in pennies and we sell in pennies per piece. And so, even though I think the platform might get the tail ends of that distribution curve, it's never really going to get that core because there's a huge cost advantage, especially if you consider freight for what Amazon's shipping. If you're selling things in pennies and freight's in dollars, that just doesn't jive. And also, I think the level of service and expertise that our distributors provide is something that they just can't replicate. Another question that comes up, I think, is 3D printing. So this is something that I would actually love to get more information on from specialists. We don't know much about it, but my opinion again is that it's good for prototyping. But can you beat cold forged fasteners? Cold formed mass-produced fasteners. Again, it's we're talking about pennies per piece. Another concern I think is with mechanical strength. So even if you take scrap steel and you melt it down and you put it into a press or into a cast, it's still considered low carbon for us. How do you get to the higher strength grades? And I'm just not sure you're going to be able to achieve that through essentially a baking process of different substrates. And the third one is artificial intelligence. So, this is actually interesting. I think, AI is becoming more and more of a element in a workplace. But I guess the way I've always seen it is that it's always more of an assistant rather than the decision maker from a very macro perspective. So, it's good at helping you plan for inventory and maybe demand management. But it's also only as good as the data it can learn from, right? So if you give it a data set, it's going to learn it and it's going to figure out the optimal way of balancing that. But it's still only as good as what you feed it. And I think 2020 has proven to be anything but historically accurate, I would say. So just a quick example I put in there. After one hurricane, AI can probably tell you what type of products are needed. I'm guessing drywall screws. I'm guessing just more supplies. But after 3 hurricanes in a month, maybe not, because people might decide to move, and AI is never going to figure that out. I think a company that does AI very well is actually probably Amazon. They use AI heavily to manage their business because it's just too vast. You have too many suppliers with too many customers and too many products in between. And so they're using AI to manage it, but you still have people. You have to have people to set those parameters and to make sure that you don't go beyond those parameters. Next slide, please. So, even though I don't think we're going to get Amazoned, I do think we might get Tesla'd. So the reason I say that is because electric cars have far fewer components. I've read maybe about a third less parts. But also, as important, there are significantly less moving parts. And less moving parts means there's basically less wear and tear. So if you look at the 2 photographs on the bottom, it's just sort of a tongue-in-cheek comparison. But on the left is it's the Shelby Mustang. It's a GT350, has roughly 500 horsepower. And if you look at the picture and you look at, all the hoses and pipes and clamps and fasteners in that thing, I mean, it's a marvel that they can put all that under the hood. On the right is it's a Tesla Model S. I just use the dual motor as an example. So there's 2 motors in that. And roughly speaking, it has about 800 horsepower equivalent in that motor. And there is no engine. There's no there's no piston, there's no transmission, there's no exhaust system. What you see there is the frunk. So it's basically the front of the car. It's basically a trunk. And I think most people use it for like diaper changes. And the difference is stark, right? On the left, you have this, internal combustion engine that's really the standard for what modern engines look like today. And on the right is, it's just an electric vehicle. Another part of this is that, for electric vehicles, when you want to increase horsepower, you don't have to redesign the engine. Like you can get a 1-motor Tesla with 400 horsepower in it, or get 2 with 800, or I think they're designing the Plaid now with 3 that has 1200. And it's just adding extra motors to that platform. You're not having to redesign the whole thing. So if you think about that, it's truly a more elegant and simple technology. And when it's that simple, it's going to have significant cost advantages. Once they get the battery cost down, the process of redesigning and innovating is going to be significantly less in terms of cost for electric motor versus internal combustion motor. So I think this trend actually will continue, if not accelerate. Another part of it is that they're looking at using large forming presses. So what that means is they're taking presses the size of a building and creating more intricate components with it. But what that means also is that it's a single component. In the past you might have more complex components using fasteners to put it all together, and that's not needed anymore. So those are issues in terms of fastener consumption. But the offsetting factors are that machines that make machines will increase with automation. So I've been reading too that COVID has accelerated the trends of automation. One example is chicken processing. We've seen the TV, or rather the news about a lot of the facilities getting COVID, and so therefore they couldn't operate. A lot of those positions are being looked at through automation now. And also, I think, a lot of what's going on is kind of limited to automotive and trucking so far, but that's kind of hard to tell at this point. But, in terms of the impact on standard fasteners is really what we've seen historically is when automotive fasteners drop in demand, it typically means that automotive factories are going more into standards. So they need to do that to maintain their production volume and maintain their tonnage. Next slide. So what does that mean? So in our view, we see diversification as being really important for the future. There's many ways to look at our industry and cut it up. You can do it by product, by material type, and how you measure it. One that I kind of want to talk about is by substrate, because I actually think that's a good way to think about what are the success factors for different parts of the industry. So what I mean by substrate is, what are you fastening? So there's, I think in the fastener world, there's 3 main types, right? There's metal to metal, there's metal to wood, and there's metal to concrete. In the metal to metal world, and that's kind of what we're all in, it's really measured by how do you manage that, the tens of thousands of SKUs and the inventory, and to do it in the most efficient way possible. That's really the success factor and driving factor for those businesses. In the metal to woods industry, which is more construction, that's actually quite a large industry. I would say that's maybe about 3 times larger than the metal to metals world. But it's not as complicated in terms of SKU management. It's more complicated in terms of marketing. And so a good example is drywall screws. If you're a drywall installer and you're putting in 4,000 drywall screws a day, you're going to notice any little nuance that screw is going to have if you use a different brand, right? So if it has a different recess or it's a different point style, it's going to have a different wobble or feel to it. So you're going to ask for brands. You're going to ask for that, that red box or yellow box or blue box because you just have gotten used to that feel. And then, the metals to concrete world is, I mean, it's a huge world too. There's a Vegas show dedicated to the world of concrete. But that's more driven by technical sales, feet on the ground, engineering sales. So I mean, as a company, we play in all three. I mean, this traditional business is, you know, our fastener line, and then we have preferred in construction, and then we have U.S. Anchor in the concrete world. And really, the three are very different from each other in terms of how it's sold and how it's managed. But it's interesting. I just thought I would share that with everyone. And also as a company, obviously, we've looked at beyond fasteners. You know, since 2015, we've gone into tools and cutting tools and PPE product. I think, sort of run out of time, but you know, the two main questions are, you know, how does a product fit your business model, right? So not everything fits for everyone. And the real question I think should be asked is, you know, is the product intuitive to your business? Meaning, can you add to it without having to add more cost to service that product? So, you know, for us, we looked at a lot of different products in the beginning, but I'll give you an example. You know, you don't have to explain how work light works, right? It's not something you have to explain how it works. You don't have to explain how a screwdriver works or how a hammer works. So to us and to our customer base, yes, it's an intuitive product, right? We could add that product without adding more cost to servicing that product. And so therefore it made that product more scalable for our business, and we could grow without adding more cost to it. And you know, another question to really ask yourself is, you know, do you want to diversify more within an industry, or do you want to go across different industries? And there's no right answer. I mean, and it's also not mutually exclusive. I think you can do both. You know, as a business, we've certainly seen, you know, different industries have underlying different currents that drive those industries. So I guess the best analogy you can think of is if you're sailing a boat, you want to have options, right? You don't want to just go up and down with the tide. You know, you want, if you have different winds blowing, you can tack to those winds and try to maneuver your boat. And so what I think is that if you're involved in more than one type of industry, or rather more than one type of factor that drives that industry, then it gives you more control over your business and gives you a way to maneuver. So, you know, that's really kind of all I had. You know, I just want to summarize by saying, you know, it's I think we're again one of the lucky industries out there, and I just hope everyone stays safe, and look forward to seeing you guys next year.
That was really informative. I enjoyed that. I enjoyed everybody's presentation. I think it's neat. From Tuesday, from Dr. Thornburg and you guys, everyone's pretty optimistic about our rebound, and that even if there's another lockdown, which let's hope not, that it will not affect us the same way it affected us the first time. So thank you, gentlemen. Questions, anybody? I know that was a lot to cover. If you have questions, you can type them in and send them to me, or you can raise your hand and I will read them. And I'm going to just double check and make sure no one's got our hand raised, and hopefully we don't have an issue unmuting you. And I am not seeing any questions, which is fine. We'll give it a couple more seconds. All right. All right. The next, we do have a question. Is there an uptick on metal prices that have to do with the tariffs? And gentlemen, I'll let, it's open forum. So whichever one of you guys would like to, you have the ability to unmute yourselves. And I'll read the question again. Is the uptick on metal prices have to do with the tariffs? Does the uptick on metal prices have to do with tariffs?
So this is John. I would just say the two issues are kind of unrelated. You know, tariffs, if they go up, probably has a depressing factor on demand, which would probably reduce metal prices. You know, the two are you know, metal prices are demand driven and tariffs are more politics driven. So it's very they're I think unrelated mostly.
All right, thank you. The next question is for John. Do you expect the political unrest in Asia to affect the fastener market?
That's hard to say. I mean, I think business and politics are very difficult to mix. You know, I think businesses in general, you know, we try to build bridges across different cultures and countries, and politics tries to divide. You know, from a business standpoint, has it already affected business? Yes, absolutely. You know, I think once the tariffs went up in China, everyone started looking at other secondary countries to purchase from. You know, we pivoted quite a bit back to Taiwan actually ourselves. But other countries are out there looking to step into that gap. So it already has affected sourcing, but from a inventory availability and supply chain perspective, I would say it hasn't, because we've done our best to neutralize those type of factors for our distributors and provide more stability. You know, I've always said, you know, in 2020, the premium and stability, you know, like if we can provide stability, that's a service that we should provide.
And
I'll piggyback on what John was saying. I asked this question of Dr. Thornburg concerning the tariffs, and you know, this is the Mike Bailey point of view. I think if Trump wins, tariffs stay, and knowing his personality, I think he looks to a punitive measure against China for the pandemic. On the other hand, follow what you read. Dr. Thornburg agreed. Tariffs probably go away if Biden wins, simply because they were Trump's, and they will be looking to weed out everything he did. And I look for him to have more of a collaborative relationship with China. So again, the volatility that's there surrounding this election is crazy in terms of how those things will be impacted.
Yeah, and this is Tim. I think the other concern that you have, I get with tariffs, but when you're talking about unrest, there are some issues. Yeah, Hong Kong, there's some issues there politically. Has that affected us? Not as much in the fastener world, because Hong Kong doesn't really produce as much fasteners. In Taiwan, it could. Those are your variables that are the unknowns. Geopolitical are huge. And so what I think hopefully we've learned from, like John had said on the tariffs, is that we need to diversify our supply base as well, to simply say, okay, if this were to happen in Taiwan, that there's going to be God forbid, some kind of skirmish with China that goes beyond, what's our alternative? And so for us, it's finding out the different supply base, looking at inventory. Those kinds of things are all things that we can't necessarily plan for, but at the same time have to be aware to begin to plan for.
Great.
So,
Guys, would you mind putting your faces up? I know, Mike, you may not be able to. If you have enough internet for our panelists, it might help if you have. There you go. Thank you.
Work?
Yes, thank you. And
there you
Mike, I know, Mike Bailey, I know you were having some connection issues. If you need to take your webcam down, I understand.
No, we're good.
I interrupted someone, and I have another question, unless you did. I didn't mean to interrupt.
well, I was just gonna, you know, I think even if Biden wins, I don't think the tariffs are going to go away. And the reason I say that is because, you know, one, I think is he'll look weak, but number two is that, you know, no one was, I guess, confident enough or crazy enough, you know, call it whatever you want, to break that system, right, of China and the U.S. You know, Trump went in there like a raging bull and just shattered it. And you know, the question I think going forward is not how do you put it back together. I think the question going forward is how do you put it back together in a way that is more advantageous tomorrow than it was yesterday, right? You know, you don't want to go back completely to what it was before, because there was a huge trade deficit, and you got to fix that. So I think going forward, people are going to look at this and say, well, how do I build a better bike? How do I build a better plate? You know, that better serves me than what it was, you know, 2 or 3 years ago.
Great, thank you. All right, Mike, when do you expect the prices to hit the oil prices to hit their sweet spot?
You know, as I said, I look at a lot of different factors and estimates. At least where I live, and the things I'm seeing in Texas, be it from the West Texas oil fields to where I am here, they're not thinking that we'll see it by next year, by the end of next year. Hopefully I'm wrong. I was encouraged by what John said about the gloves picking up, because that is a sign. But boy, it's pretty bleak out here, and you know, a lot of people celebrate spending $1.50 to put a gallon of gas in their car, but when you live here and you see the impact, it's kind of a bittersweet thing. So hopefully, I'm going to go on what John was saying, but we got some work to do for sure.
Great, thank you. Mr. Jamie Lawrence, has the
Yes.
lack of labor increased the interest in automation?
Absolutely. And I like the comments about artificial intelligence and automation with labor issues. And it's interesting. Last year, because of the high demand and the very strong economy, it was very, very difficult to find people that were willing to work and were qualified to work. And even moving into, if you have a manufacturing company, say to a third shift, it was difficult to find people, if at all, for third shift. So definitely that pushed, speaking from a manufacturing standpoint, pushed many of our companies to seriously take a look at automation.
All right, thank you. Mike, do you really think that Trump actually blames China, or is that just one of the talking points to rile up his base?
Oh Lord, are you trying to put me in that man's head? You know, I think it's probably a combination of both. His base has been riled up enough by a lot of things in the last, since the pandemic started. But I don't know. I'll keep the Mike opinion to himself. I know there are people in China that need some help, and just identifying the government as being the big evil, it cuts short what's really going on there. And I would like to see us maybe be a little bit more becoming with them, while still trying to figure out what the cause of all of it was. It's not like we're going to be able to send them a bill. So now it's all just become rhetoric as far as I'm concerned.
Thank you. All right, next question. Do any of you have insight into what the real status of COVID cases and deaths are in China, and how the virus will show their demand or ability to supply products over the next few months?
No.
I don't even think the people
No.
in China have that.
I think it's media blackout. There's no way to know.
Yeah.
All right. All right. Anyone
The
else?
only thing I want to, can I address that just a little bit?
Please.
The only thing that I see that has impacted the supply chain, and the three of these gentlemen can probably respond to it better, is my understanding that due to the concerns of the Chinese environment, some of the manufacturing was brought down a level regarding plants that were not able to produce product efficiently with environmental impact. They're spewing a lot of smoke and debris. Many of those factories were turned off from a year or so ago. I don't know if that's still the case or not.
Thank you, Jamie. I don't see any other questions, but a couple people have commented, is there any way that participants can see other participants? And I think that's a great idea. We don't have the ability to do that, but it just like an in-person conference, it's kind of fun to see who else is there. So possibly for Tuesday, we'll see about what we can do to get all the attendees. I know we can allow 25 attendees to show their webcam at once. So maybe we can kind of play around with that so that all of you, the attendees, can see your fellow friends and colleagues who have joined, and make this a little bit more interactive for you guys. That's it for questions. Unless I don't see any others, but I want to thank gentlemen. That was, as always, I've attended this in person. It's one of my favorite dinner meeting topics. You guys did a great job. Very, very informative. Everybody, the next session for our fall conference is next Tuesday, October 27th. For lessons learned from the pandemic, a crisis management panel. It's a panel discussion. We want involvement from the attendees, so come with your questions or comments. If you have some pearls of wisdom that you want to share, the panelists are just summarizing their experiences. So we definitely would like to see and hear your input as well. A new link is going to be sent out for Tuesday's meeting. So today's, delete it. You're going to get a new one. Later today, you are going to receive a survey from Jamie Adams. Please take a moment and let us know how you thought about the first 2 sessions. We really value your opinion, and always offer suggestions for future webinars, meeting topics. It's really important to us. All right, one FTI plug for the afternoon, and that is we are returning to in-person classes for Fastener Training Week in Cleveland this December. So check our website out. Please come. There's everybody on this call in this conference gets a discount to our classes. So check us out. That's all I've got. I hope you guys have a great afternoon. Thank you again for attending, and thanks, guys. That was awesome.
Thank you, Joe.
Thank you.
Bye.
Bye.